right, welcome back to the Deduction Desk for another episode. I'm your host, Joe.
I'm Sagar.
Today we're going to be focusing on backdoor Roth IRAs, understanding what those actually are, how they work, and what opportunities some of you may have to put yourself in a better position.
Yeah, I think when you think of the power of a Roth IRA, especially in recent times, probably the biggest case study in this is Peter Thiel, the owner of Palantir, former investor in PayPal, multi-billionaire, super powerful guy. And he was so ahead of the curve with some of this stuff. He's synonymous now with how powerful a Roth IRA can be. Something he did with PayPal, and I think this was there was like some leak that happened with the IRS, and this is where some of this information comes from. Ultimately, what happened is when Peter Thiel started his investment into PayPal, which was I believe his like second or third exit, and he had done some smaller ones previously, and he kind of learned the ropes. He took a good chunk of his initial C Corporation shares from when he started the business and purchased them through a Roth IRA account, a self-directed Roth IRA account. And at the time, the value of those shares was $2,000 because it was a startup company. It was probably within the first few days of starting the business, no activity, no real transactions. Took advantage of that and sold them from his personal name to his self-directed Roth IRA. When he exited PayPal and they had their big buyout and they went public and all these things, he ended up getting somewhere around $5 billion completely tax-free. And we'll find out how the Roth IRA works, but basically the growth that occurs from that 2,000 to 5 billion is tax-free, which happens in almost every type of retirement account. The growth is usually always without tax. The difference is with that Roth IRA, when he turned 60, he was able to take that money out with no taxes. That is not something that happens with every type of retirement account. That only happens with the Roth, and with really just having an elite level of knowledge of how the IRS works and how these systems work, he was able to make multi-generational wealth and not pay $1 in tax on it.
And he got ahead of the fact that he could put money into a Roth IRA when the business was worth nothing, and being able to establish those types of accounts. Obviously, working with a tax professional or working with a financial individual is important before you're making some of these decisions, because everyone's situation is going to be different. But let's dive into backdoor Roth, right? What is it? I think a key point, right? Because everybody hears backdoor Roth, but why is it backdoor, right? Why isn't it just Roth IRA? Because there is a Roth IRA, but backdoor Roths are required for certain people over a certain net worth. So let's talk about traditional Roth IRAs. From a Roth IRA standpoint, it is one of the only retirement vehicles that you have the ability to save into on an after-tax basis and have earnings and growth deferred until your retirement age tax-free. Now, sounds great. Sounds like it's probably the best plan and best opportunity available out there, and it is, but unfortunately there are rules and regulations that come along with it. And one of those rules specifically being, what is your current income, and does your income qualify you to actually have a Roth IRA?
And I would even interject to that point where it's like, you don't want everything necessarily in a Roth IRA, right?
Yeah.
It depends on your personal situation, right? You don't get a tax deduction up front. That's the point of the Roth, right? You're saying, I'm putting in post-tax money. So you pay all your taxes, you have a bunch of liquid money sitting there, and then you say, I'm gonna take some of this and put it into this Roth IRA. Now, I didn't take the tax deduction up front, but as a trade-off with the government, when you take the money back out, you're also not going to pay taxes on it. Whereas it's the opposite with a SEP IRA or a traditional IRA or even a 401k, where you're taking the tax deduction now, which if you're in a really high tax bracket, that might be something you want to do. And then you're going to pay taxes when you take it out, but you're hoping that your tax bracket is lower in the future, so you don't have as much of a tax hit as you would if you would have just had regular taxable.
So that's a good point, right? Having a combination of both sometimes makes sense. Again, check in with your accountant and your professional to make sure that distinction is there. But there's two components to it, right? Number one, what your income is, and then number two, how much you actually have the ability to contribute. For individuals, single filers who are making over $161,000, you're getting fully phased out of contributing to a Roth IRA. The government says you make too much money. Unfortunately, you're not allowed to make that contribution, which For people under 50, age 50 is $7,000 in 2025, and then you have the catch-up provision over age 50 of $8,000.
And that might sound funny to you because you're like, well, isn't this what I always hear a bunch of rich people are using these?
Right.
And it's like, yeah, they are, even though it's not really meant for them.
Right.
Like the IRS has specifically wrote this stuff where, hey, this is for if you are making under, $240,000 as a couple, 161 as an individual. This is for you. You put your money into the Roth. It helps you grow in income and it helps you pay for retirement in the future. Obviously, rich people are going to find that way to take advantage of whatever is out there.
And the tax code allows it, right?
Yeah,
And this is kind of where the backdoor portion of Roth IRA comes in.
Yeah. And is it allow it, or do you think that we've kind of been clever in helping some of these folks over the years find this loophole?
I would say that there's definitely knowledge that it's happening. And I think there's a difference and a fine line between you egregiously doing it and taking advantage of the fact that it hasn't been exposed and you doing it the right way. And I think that's some of the stuff that we're going to talk about.
Congress really wanted to close it, they would close it.
Yeah.
So it's open for a reason, so take advantage of it while it's open.
Yeah, and let's talk about it, right? So there's also different rules and regulations when it comes to contributing to an IRA and getting a deduction if you have employer-sponsored plans that you have access to. So whether it's yourself and your spouse is the only one that has access to the plan, but your income is over a certain point, you can't deduct the money that's going to your traditional IRA. And that's something we'll probably cover on another call. But whether it's traditional IRA money or whether it is money that you contributed to an IRA but it wasn't deductible, you have the capacity or the capability to convert that money into a Roth IRA at any point in time and only pay the taxes on what you're converting. So when we talk about backdoor Roth IRA, right, it's more geared towards non-deductible IRA contributions. But let's first start with traditional IRA. You fund a traditional IRA for $7,000. The same year, maybe within the same breath, you decide, you know what, I'm gonna convert this money into a Roth IRA.
And this is as a person who's eligible for an IRA, meaning somebody below that 161,000 income, correct?
Well, that's Roth. That's for Roth. Traditional IRA, anybody can fund it as long as your income or you don't have access to a retirement plan for the business.
Yeah.
So if myself and my wife are both working and neither of us have access to a retirement plan, then there's no income limit. We can fund a traditional IRA as much as we want.
Yeah.
If I have a retirement plan and my wife doesn't, depending on how much combined income we have, it will phase you out of being able to actually deduct the contribution into that traditional IRA.
And remember, this might be a good thing for you. If your strategy is backdoor Roth IRAs, which is what we're talking about, you want to be in a position where you cannot contribute to your IRA. So you either want to be offered a 401k plan at work, whether or not you contribute to it, as long as it's offered, it qualifies as you being somebody who's in that position. And you want to be making over a certain amount of income combined or individually so that you are ineligible for this traditional IRA contribution.
And the deduction with it, right? That's the big important part about that note. And again, having these conversations with a tax professional and making sure that you have an exact understanding of how it works is important. So now my wife and I both work. I have access to a retirement plan through my business. She does not, but our income does not qualify us to deduct a contribution into the IRA. That's okay. We can still contribute to an IRA, but all of the earnings are going to be taxable, right? We don't get a tax deferral. We don't wait till we're retired. Now, why would somebody do that, right? Why wouldn't you just open up a brokerage account and then just move the money into there and pay it every year? That's because you have the ability to backdoor into a Roth IRA.
I'd also say because you also don't have to pay the taxes right away, right?
Yeah.
If you invest into a traditional IRA and it's non-deductible and there's growth that occurs and you sell something,
right,
you would not have a tax consequence.
Yep.
Whereas if you did that in a regular brokerage account, you would have a tax consequence. So there's some value there too, even though it's not the greatest thing to do to put into a traditional IRA non-deductible because you don't get the tax deduction up front. There's still some value there.
Yeah. So let's say you contribute the $7,000 to a non-deductible IRA. The money that's inside of there on day one, immediately you decide, all right, I have money in an IRA. I'm going to convert this into a Roth IRA. You didn't get a deduction for the $7,000. So now we move the $7,000 into the Roth IRA, and now every dollar from that point moving forward is tax-free. That's the idea of a backdoor Roth, but this is what I was talking about before about taking advantage of the rule and the ability for us to actually do this backdoor offering, because there's no chance the government doesn't understand that this is a capacity. I think this is probably one of the only gray areas in the tax code from a retirement plan standpoint that they kind of turn a blind eye to, because you could technically say, I make $500,000 a year, I'm gonna fund a traditional IRA without the deduction, and then I'm just gonna convert it to a Roth immediately. Well, then I just funded a Roth IRA, right? So what is the timeline? There's been different answers from different positions. I would say most often it is about 6 months to a year of holding that traditional IRA non-deductible contribution. So you put the money in $7,000, it grows to $8,000, you pay a little tax on the $1,000 that you're converting, and then the whole contribution then goes into a Roth. And if you did that every single year, you're not taking advantage of the tax code, and you still have a plan to convert it to Roth at some point, but you're not doing it immediately. And I think that's a big difference in coming up with that explanation and not taking advantage of that gray area that we have access to.
Yeah, so sort of recap, basically, you put the money in, non-deductible, so you don't have a tax consequence. You then convert it to the Roth, which typically would be a taxable event. That conversion is basically done tax-free. So you put $7,000 in, non-deductible, convert it to the Roth IRA, say the value is still $7,000, then there would be no tax consequence for you there. And now you've basically converted into a Roth IRA, you've contributed to your Roth IRA, even though you're ineligible, right? To Joe's point, let's say you put in the $7,000 and it goes up to $8,000, same thing, you do the conversion and you pay tax on that $1,000 difference, but you're still able to get a bunch of money into your Roth IRA.
Yeah, 100%.
Now, what happens in certain situations, let's say you have been contributing to your IRA and you've been putting money into there since you were, first started working, and now you've crossed that threshold and you're making more money and you still want to put into the Roth, but you're no longer able to. Well, there's still the opportunity to do it. It just becomes a little more taxable, right? So we'll give you a quick example here with real world numbers, right? Let's say you've been putting money into your IRA and it's grown. You took the tax deduction when you were younger and now there's $95,000 in that account, right? And this year you decide you want to put in $5,000 that you want to backdoor into a Roth IRA. When you put in that $5,000, you have a total of $100K, right? But you can't just say, I want to only convert this $5,000. It's based on the entire bucket. So you had $95,000 deductible, $5,000 non-deductible, 95% deductible, 5% non-deductible. As a result, when you do the conversion, you're gonna pay tax on 95% of whatever you convert. Whether it's $5,000, $10,000, $50,000, whatever you're converting, 95% is taxable, 5% is non-taxable. So we don't want to do that, obviously. We want to be smart about this. We want to make sure we're not in that situation. A quick, easy way to avoid that scenario is you take your $95,000 that's sitting in this traditional IRA account and you move it to maybe your 401k. Or you move it to a SEP IRA that you have. You move it to another retirement account where the money can go and sit there, and then you do your backdoor Roth conversions. This would basically put you in a position where you would now have only $5,000 in that account. So when you convert it, you're converting 100% of the account. 100% of it is traditional non-deductible contributions, which means you avoided all of the tax. Keep in mind, when you're trying to do these conversions, you want to have that non-deductible IRA account as close to zero as possible to avoid the tax on the Roth IRA conversions.
Yeah, who thought Roth IRAs would be difficult?
Yeah, right? This is why you hire someone to do it so you don't get nailed. We've seen this before where clients like, well, I saw online that you can do these big conversions. It's like, yeah, you can. You just have to plan it out a little properly.
Yeah.
And then another little things, make sure you're filing the right forms. Make sure your tax professional is filing the 8606s, which is like the yearly, just letting the IRS know what's deductible versus non-deductible in your accounts.
So who's this good for, right? If we're going to be looking at this video and saying, am I a candidate for this or not? I think probably the most important thing to consider is, number one, do I even qualify to fund a Roth IRA, right? If I'm making under 161,000 as a single individual or under 240,000 married, then you can fund a Roth IRA. You're ahead of the game. You're better than most people. You can fund it. So you don't have to do this backdoor Roth IRA or these other conversions because you have the ability to do it yourself. So starting off is individuals, high income earners that are over that Roth IRA limit. Over 161,000 as a single person, over 240,000 as a married person. Other individuals are people that don't already have pre-tax IRA money, right? You don't have IRA money that's set up in pre-tax. That helps kind of distinguish the difference between the non-deductible IRA money and the deductible IRA money. Another example would be someone who, obviously wants to grow retirement funds for a longer period of time. Other than certain situations particular to, your RMD requirements, which Roth IRAs do not have an RMD requirement, and legacy planning, you want to do this earlier on. Because the conversions
and
are
what's
met.
an RMD?
So an RMD is a required minimum distribution. So at some point in time, any money that's pre-tax, meaning money that you haven't paid taxes on yet, so 401k contributions, traditional IRA with the deduction contributions, the government says, all right, you've hit a certain age, now you're going to require you to take money out of this plan. And there's a minimum each year. The older you get, the more you need to take out. Every dollar that's in a Roth IRA does not require a minimum distribution. There is no RMDs. So from a legacy standpoint, from passing money on to beneficiaries, those are sometimes a little bit more effective ways to do it than just doing it from, your retirement money gets passed on. But for someone who is looking at utilizing it for retirement specifically, you want to have time for the money to grow inside of that plan, right? You want to be able to say, okay, I'm going to do these Roth conversions each year for the next 10 or 15 years so that all of the money inside of that account, all the earnings that you have are tax-free. That's probably the most beneficial part of it. And then really hedging against future tax hikes. The anticipation, and Sagar mentioned this in the beginning, is that you fund pre-tax accounts because in the future, our anticipation is our tax brackets are going to be lower, or that your tax bracket's going to be lower because inadvertently your income's going to be lower. But I think most situations, we want to be able to get as much money in retirement as we can so that we can live the retirement that we wanted to. So who says your income is going to be that much further off? And if that's the case, then your tax bracket may be higher. You look at other factors that obviously we don't know what the results of those are going to be, but those things are important to take into consideration.
One of the things that I hate the most is when I try to go find a recipe online, or I'm trying to look up a quick tutorial on YouTube and it's two dudes just yapping for hours about something and I just want like the quick hit. So this is going to be a section we're going to add in where we will just quickly run through the key criteria you need to know here, right? So who does this work for? It works for people who are high income earners who are already unable to contribute into their typical Roths. If you're not earning more than 161,000 as a single person or 240 married filing joint, then just put it into your Roth traditionally. You have nothing stopping you.
Doesn't apply to you.
This is a strategy for people who make more than that, okay? So if you're in that bucket, you want to put money into your Roth IRA, step one, make sure you don't have anything else in your traditional IRAs. Get that money out of there. Get it into a 401k, get it into a SEP. Two, put your traditional contribution that you would normally do, 7,000 or 8,000 if you're over 50. Put in that money and put it in non-deductible. Don't take the tax deduction for it. Fill out your 8606s. Make sure you enter all the proper documentation into your filing of your tax return for that year. Then convert it from a traditional IRA to a Roth IRA. You're going to get a form from your broker, a 1099-R, that says this is a taxable conversion, okay? But you're not going to pay tax on it because the initial contribution was never tax deductible. So that's the quick and easy way to do a backdoor Roth.
All right, so that's the wrap up on Roth IRA and backdoor Roth IRA. Again, questions that you have, contact your financial professional, your tax professional, or obviously there's opportunities to speak with us as well. We look forward to seeing you on our next video.
See you guys.
Thanks. It wasn't recording. No, I'm just kidding.
Wow.